Everybody, thank you so much for a fantastic turnout this time of the morning. Before we start, I'd just like a little show of hands. I know most of the people in the room have been in business for at least 3 years, so quick show of hands as to how many of you feel that business is a lot tougher at the moment than it was 3 years ago. Yeah, okay, that's pretty much everybody in the room. Okay, second question, how many of you feel that business in 2011 is going to be tougher than 2010? Yeah, okay, that's the majority of the room as well. Spring might be coming, but the economic green shoots of recovery don't appear to be raising yet. Hopefully today you're going to go away with 1 or 2 ideas that fit your business. Obviously this is a generic presentation that's designed to sort of cover as many businesses as possible. So some of the things that we might talk about might not be appropriate or even relevant to your business. But I'm pretty certain that there will be 2 or 3 things in this presentation which you can take away and apply back at your business. So a little bit of background. And thanks to Kevin Beck of Fleet Commercial Finance, who gave me some of this content in one of his presentations. The effect of the credit crunch, which we're still feeling. Virtually all the foreign lenders that were around in 2008 have left the market now. As a result, the available lending has reduced by about 50%. And a lot of new lending is not actually new. There's a lot of people that have had term lending arrangements with a particular bank, and they've got to the end of that term and they can't find anyone else to lend to them. So the bank that they're with has been forced to renew that finance, often at possibly slightly higher interest rates. So a lot of that new lending that's there is actually being taken up by people that are renewing existing loans. As a result, the people that are lending have more people to lend to than money available to lend. So they're going to cherry pick the best cases, often the ones with the best security. If you were lending money to somebody, you had 2 people to lend it to, you'd lend it to the one that had the most chance of repaying you. What that means for any of you who have got businesses which are actually growing at the moment is that the main way you're going to have to finance that growth is through profits, because it's just going to be that much tougher to borrow money. So the impact on small businesses. The first one is potentially the death of the overdraft, or the death of the big overdraft anyway. Overdrafts banks often have a difficulty with the security available on overdrafts, which is why it's easier for you as a business owner to get factoring or invoice discounting. It may be more expensive and it may mean a bit of upheaval in your administration, but from the bank's point of view, they can assess the security that they've got on a day-by-day basis, and as a result are more likely to give you a factoring or invoice discounting arrangement than they are to give you an overdraft. Quite possibly more finance needs to come from the owners of the business. That might mean actually putting in a little bit more money yourself. Again, one of the things that we're finding is that the banks are more likely to lend to those who have put some money in themselves than to those who haven't. And lastly, possibly more of your profit needs to be retained. So that might mean taking a good look at the amounts that you're drawing from the business. Now, potentially, you could be suffering some cash flow problems at the moment. And the first question I always ask anybody who says they've got cash flow problems is it really a cash flow problem, or is it actually a profit problem? Because most people with cash flow problems, the real problem is that their business is below its real break-even point. And your break-even point is the amount of profit that you need to make to pay your tax and pay the amount that you're drawing out of the business. So here's a little break-even point calculation, one we prepared earlier, as it were. And effectively, it's a profit and loss account in reverse. So we start off with the amount of money that the business owner needs to live on, take off any other income that they've got coming from outside of the business, work out from there how much tax they're going to pay in order to have that amount of drawings. So the profits in that business would need to be 55,190. Add back on the overheads, and then applying whatever your gross profit margin is will work out a sales figure for the year. What we like to do then is actually seasonally adjust that figure. So there is a tendency to work out a break-even figure and then just divide it by 12. If you do that, then some months you'll be patting yourself on your back that you've hit your break-even point, but if those are the months of the year where traditionally your business does quite well, you might actually be not making enough profit in those months to carry you through the poor months. You should, if you are in a cash flow difficulty, you should be looking at your management account. So again, here's one that we've doctored from a client's records. Typical profit and loss account of the business showing the figures for the month and the figures for the year to date. The report that I always like everybody to look at is, if you use Sage, is your prior year report, because that actually tells you not only the figures for this month, but it tells you the figures for the same month last year. And you'll have a good idea what was going on last year and why last year might be better or worse. It also makes it easier for you to identify anything unusual, any big costs that are sticking out in comparison with the same period. Many business owners don't look at their balance sheet because they find it a little bit hard to understand, and sometimes that's just simply a bit of a formatting issue. Sometimes it's because they've not asked the questions. But you need to have a look at your balance sheet every month just to see which direction all the assets and liabilities are going in. Now this is the figures down the right-hand side are a summary of the assets and liabilities. The figures in the middle actually show the movement, so how much they've gone up or down by during the period in question, just 1 month of July. And I'm just going to show you how you can play around with those figures to actually understand the impact on your cash flow of certain non-profit related issues. So other cash flow challenges, you may be at break-even point, but actually potentially could be that your debtors are taking longer to pay. Could be that you've got a growth in turnover and that you find yourself in the "where did my profit go" scenario. And that's a question I've been asked several times by clients over the years. They've got a set of accounts off of us, they're showing a reasonable profit, and they say, we can't have made that much profit, there'd be more money in the bank. But actually that balance sheet that I showed you, if you understand what some of the figures mean, you can identify why you've got a profit in some periods and negative cash. So here's an example here. You've got a profit shown in the accounts. Add back a couple of things that are often put in the accounts that don't affect cash flow, the depreciation, provision for tax. But then, as you see, you've got some big negative influences on your cash flow. You've bought some fixed assets, you've got extra stock in there, customers are taking longer to pay, and you've had to repay some loans. That's £18,000 that's gone out of your business in cash flow, which doesn't actually appear on the profit and loss account. But then you've got some positive impacts on cash flow. So the suppliers, you're able to take a little bit longer to pay them. You've got the VAT man gives you a little bit of credit, so you can use that for cash flow purposes. But as you see in that example, you start off with a profit, but actually you've got a negative cash flow in that month. And all those figures appear on that balance sheet that I showed you in the movement column. So those of you who've got Sage, run off a balance sheet for the last month that's complete and have a look at the month column in there, and you'll see those movements. One of the things I encourage clients to do is what we call the 5-minute cash flow, because it's easy to get a little bit complacent about your cash flow at certain times of the year. And if you do this exercise at the end of every month, as soon as your bookkeeping's finished, you run this 5-minute cash flow, then you can start to anticipate some of the problems that might be up ahead. So, very simple exercise. You just enter in, first of all, how much money you've got in the bank, and then you add on to that whatever your overdraft limit is. So in this example, they've got £6,800 in the bank, they've got a £10,000 overdraft limit. That means they've got £16,000 of available funds. But at this particular time of the year, they ought to have more than that, because they ought to have £4,000 set aside for the company's tax bill, because they're only 9 months to go until that's payable. They're halfway until the next big insurance bill is payable. The VAT is payable today on that example, £10,000 of VAT payable. The rent is payable in a couple of months' time, and the PAYE is payable now. So they ought to have £28,000 available in that example, and they've only got £16,000, and indicating that there is a shortfall there. And if you do that exercise every month, you start to see a little trend emerging. There may be some ups and downs based on one big customer not paying you, the day before the end of the month or the day after. But other than those discrepancies in there, you will start to see a general trend up or down. And if you're showing a big surplus every month and that surplus is getting bigger, you're pretty safe ground to draw some more money out of the business for whatever things you want to use it for. But if you're starting to show a shortfall every month, that shortfall is going to catch up with you at probably the point when your tax bill is payable. That's normally the worst cash flow point for everybody, because most of you have got a limited company that you run, or you've got an LLP with a limited company partner in it, and most of your tax is payable once a year. But if you start having to talk to your bank a week before it's payable, or relying on negotiating with the revenue over instalments, then you could be running into some problems. Now, 2.5 years ago, the revenue were incredibly sympathetic to cash flow problems. Their sympathies seem to have dried up a little bit in the last 12 months, and they are getting tougher and tougher on collecting the money that's due. Now, theoretically, an accountant will tell you there are only 4 ways to improve your profit. Number 1, increase your turnover. And within that, there's 3 ways of doing that. Firstly, get more customers. Secondly, get those customers to buy bigger versions of whatever it is that they buy from you. And lastly, get them to buy more often. As I said, that might not be possible for some of the industries you're in. It's pretty difficult for us to get clients to buy an annual set of accounts more than once a year. But the second way to improve your profit is improve your margins, either by more efficiency, by buying cheaper from your suppliers. Lots of different ways depending on the business that you're in. For retail businesses, theft is a big problem. Can be for any business that's got stuff that can be sold on eBay relatively easily. The third thing is to try and reduce your overheads. Now, when things were good, you possibly became a little bit complacent about some of your overheads. There are quite a few good consultants springing up that will look at all your utilities costs, your rates bills, stationery costs, all of those things. It's worth having a look at those things now just to see if you can get where you can make some of those savings.